Just earlier today, it came out that David Tepper was aggressively buying Chinese stocks in the fourth quarter. This follows a prior video that I did at the end of 2024, calling out how he was saying, look, everything China was up for grabs in terms of buying it being a potential opportunity, and that their amount of stimulus blew away expectations because of how aggressive that they were being. This was an interview that he did on CNBC, and you can see what he's been buying. You can see Alibaba, he was adding hundreds of millions to these various different Chinese stocks. Alibaba, JD, various different Chinese ETFs like FXI and KWEB, along with Baidu. And so in this video, I'm going to walk you through not only the position sizing, that he has, sort of a macro, very high level macro perspective on what is he seeing, as well as sort of diving into the individual thesis. What's the upside from here? Because some of these Chinese companies have, the bottoming process and are starting to recover. So the question is there significant upside? As always, if you enjoy educational investment content, you're watching Unrivaled Investing. Let's dive right into understanding what is going on. So looking at his portfolio, you can see Alibaba, largest position, over 15% of the portfolio, and he was adding to it. So this is as of the end of the year 2024, also adding to PDD, also adding significantly to JD.com, and you can see FXI. So looking at these different positions, it's clear that this is well north of 30% of his portfolio, and this is a multi-billion-dollar portfolio. And the high level sort of macro is that the Chinese government, if you look at their Politburo, they're aiming for an appropriately loose, and that's what they've said, monetary policy, cutting rates for the first time in years. And, Ray Dalio, plenty of prominent investors have called out, be aware of the macro, be aware of, what are the biggest players like the government telling you to do, because oftentimes it makes your life easier as an investor. So if the government's telling you, hey, we're going to juice the assets, we're going to make it a more friendly environment for investors, you should be aware of that. And so for them to talk about an appropriately loose monetary policy, that does, make it more favorable for Chinese stock investors. So that's one of the things he's seen. He's also seen that, they've announced effectively a war chest. In one case, it was around $100 billion to stabilize stock prices. So this gets to the point of, the Chinese government is very clear. They want to turn things around. They want consumption to improve. They want to get past the real estate crisis that they've had. So looking at it, not only do you have the stimulus from the Chinese government saying, look, we're going to, juice things up, but you're also looking at very low valuations, across the board for these top Chinese companies, broadly looking at, very low teens or high single digit earnings multiples for next year. And I'd argue it's even lower when you factor in the cash on the balance sheet or the investments that they hold, in which case really you're talking about to mid to high single digit earning multiples for many of these different companies. So that could suggest a lot of upside. Think about just where US stocks are trading. US S&P 500 roughly around 23, 24 times earnings. So this is less than half the valuation for some of these, arguably some of the best businesses in China, less than half the multiple relative to the US. And not only do you have David Tepper, you might think, okay, he's just gone off his rocker. You're also seeing other super smart investors, the Smart Money, Porter Collins and Vincent Daniel. These were actually the guys from The Big Short. They currently manage money from under Seawolf Capital, and they have recently been on CNBC talking about how, look, Baba just looks interesting. They're talking about the risk reward at the valuation. They were, saying the exact same thing that I'm saying to you now. They were calling out around 5 times earnings adjusted, for cash and investments for Baba, and saying, you don't have to have a lot go right to have this, work out significantly for shareholders, where you could see 100% plus upside type of potential. And not only do you have these dynamics that have turned more favorably for investors, but you're seeing that they're aggressively repurchasing shares. And since, March of 2023 through the end of 2024, they've spent billions of dollars, and this is in the case of Alibaba, they've spent billions of dollars repurchasing shares, and they've reduced the share count by about 10%, and they still have $20 billion remaining on buybacks. So a lot of buybacks. So let's focus on Alibaba because this is his largest position, over 15% of the portfolio. So what does he see and what's going on from here? Let's analyze the fundamentals a little bit greater clarity. You can see from a fundamental perspective, this is the revenue picture as of September 30th, 2024. They haven't yet released their December 2024 figures. And historically, Taobao Tmall, that's their core e-commerce platform. That's what historically created the bulk of the value. And it's just not growing significantly at all. You can see that the revenue was effectively zero. And so they're clearly losing market share. But this is still the largest e-commerce company in China, so that is worthwhile to understand. And there are other segments that are growing, such as their cloud business and their international segment, which is growing nicely. And then you also have some other assets like their logistics and local services businesses that are growing a little bit faster than their core e-commerce business. So a lot of interesting assets. Their cloud business could be a ray of light for them. And, Taobao Tmall, yes, they're not growing. Yes, they're losing market share, but they're still big, still highly cash generative. And, in terms of that cash generation, you can still see that they're generating, billions of dollars, tens of billions in RMB. They're doing an aggressive share repurchase. And by the way, they still have $50 billion in net cash on their balance sheet as of September 30th. So relative to, let's say, a market cap of around 250 billion, just cash alone is roughly 1/5 in terms of Alibaba. Then when you start focusing on the other assets, other investments, maybe you bump that up to closer to 100 billion. So a huge, element of Alibaba is not just their core businesses generating lots of profits, but these other assets. And I think investors do like to see the disposal of these either unprofitable or really low margin retail assets such as SunArt and InTime, which is more recent announcements from management. This is, management sort of having their religious moment of saying, we want to focus on the high return on invested capital. Our previous initiatives weren't working. We're going to focus on what's really cash generative and focus on the consumer. And, maybe this whole physical retail approach, it didn't make sense. It's not working. Yeah, you don't like to see the waffling. You'd rather see hey, we're going to commit to this and this is a great idea and it works. But in this case, they're saying it didn't work and they're effectively disposing this for a couple $2 billion, having some losses tied to it. An example of how Alibaba could work, even if the underlying fundamentals stink, is just the change in sentiment, where here it is, they're talking about how they have a new AI model, Qwen, where they're saying, look, it's very similar to the DeepSeek Chinese model that came out that caused the whole world to go, holy moly, now China has a reasoning AI model that can challenge OpenAI. This is an example of, I think, a call option on Alibaba that a lot of investors aren't even aware of or they're not even playing for, which is that if Alibaba says, hey, we're now the OpenAI of China and you can get exposure to some of the most cutting edge AI models from us, then that changes the whole perception. Then investors might say, wow, this should get a much higher multiple than closer to 10 times or less, when you factor in the assets that they have. That can turn it in from a oh, it's China to whoa, this is a revolutionary type of business. It's this new hyper growth AI sort of play. So you could have that change in sentiment. And sentiment's going to be a key part, I'd argue, of the thesis, when you think about it. And there have even been rumors that they might acquire a stake of DeepSeek, buying it for buying a billion dollar and making it $1 billion investment for 10%. That's been rumored, but they've said, it's not happening. So who knows? That alone, though, could change the sentiment. What are my thoughts when we look at Alibaba? First of all, as always, this is not financial advice. And also, quick plug, recently Venu, a premium member of the Unrivaled Investing community, shared the following. This is a direct quote. Joining your membership has been one of the best investments, both in terms of value and personal growth. This follows A. Woods, who wrote, I'm currently ahead of my investing goals to retire at age 45. That's thanks to Unrivaled Investing. So if you're looking for compelling ideas, come check it out. That's unrivaledinvesting.com. When I look at Alibaba, I think it is important to recognize that in the past year, it has fundamentally changed. It's no longer in that sort of death spiral lower. In the last year, the stock is up over 50%. The reason why that's important is because that's suggesting that the tides might be turning. And that's enough to get a lot of momentum-driven investors, hedge funds to say, oh, this story might just be starting. So then they start looking at the fundamentals and say, does this story have juice? Because, hey, if this is, I'm not going to catch a falling knife. That's the way a lot of investors, think, it's too hard. I'd rather wait, I'd rather miss the bottom, but ride it. I don't need to get the first inning on the new bull market. I can get it on the third inning and ride it all the way through. And so I think it's important to have this sort of, this development, this 50% plus growth in the share price, despite, sort of underwhelming fundamentals, because it does suggest the macro elements of the Chinese government. It does suggest the policies from management. It's getting the animal spirits and it's getting investors to say, this might be worth a lot more. And this is where it comes to, okay, so is there enough of a thesis to get the stock price significantly higher from here? I think, doing not only the monetary policy and the stimulus, also having a dual primary listing on, with Hong Kong, so that way you're able to encourage Chinese savers to invest in BABA. That also, increases the odds that you get a higher share price type of dynamic. But when you look at the fundamentals, I really, really, really do not like to see that Taobao and Tmall are effectively not growing, while JD and PDD are growing much faster. JD's a bit slower, but PDD is much, much faster. So they're clearly taking market share. And for me personally, as an investor, I always prefer to, that's a good red light, green light type of test. If you have a company that's rapidly taking market share, it suggests you're doing something right. And it gives you a little bit of comfort that, oh, okay, maybe you can keep doing that in the quarters ahead, and it helps you from an investment perspective. Right now with Alibaba, we're talking about the cash flow being returned to you as a shareholder, and you get the buybacks. But seeing this is a red light, like, it's harder over time when you have this type of dynamic. And, for my own personal investment checklist, aligned management, you have the chairman, founder, Joe Tsai, he's back, he's helping govern the company. So that's what I like to see. You have arguably a very compelling valuation, trading around 10 times, arguably lower if you factor in the cash and other assets. This is the one where it sort of breaks the obvious growth potential. And I would just much rather find something where I could say, yeah, definitively, this is going to be much, much larger in the future. The blow-up risks, that's also something we're going to talk about in a second. So, at this point, I think it's very obvious to me that this doesn't fit my own personal checklist because of that obvious growth potential. When you see the red flag of you're losing market share here, what's really driving the growth? Because you could be in a situation where you lose market share and maybe even sales decline in the future for Alibaba. So I look at Alibaba and I'm looking at all these data points and I view it more as a special situation. So I could understand why these super smart investors like David Tepper and the Seawolf folks are buying it, saying, look, it's just so cheap, and the macro has become much more favorable. Personally, I don't own any Alibaba, but I can understand why investors would be so excited about it. And it comes down to, from a fundamental perspective, looking at their core earnings from Taobao, Tmall, from cloud, you're generating roughly 200 billion in earnings before interest and taxes and amortization. And so that's around $20 billion net, $20 billion, net profit. You can think of that roughly as free cash flow that investors could get. So what's $20 billion worth relative to a company with a $250 billion market cap and 50 billion in cash? What's that worth? So 200 billion less than that enterprise value versus 20. So you're saying 10 times, net of cash, a lot less if you factor in some what these other assets might, sell for. And so my view is this is largely because growth isn't such a big part of it at this point. I mean, their cloud is picking up, but it's not, crazy growth. What I would say is this is really a sentiment story. And there are always three factors that drive your returns. There's the, what are the fundamental growth? Can you pencil out 5, 10, 20% type of growth over time? Is it obvious? For me, I'm looking at this, it's less obvious that the fundamentals in terms of growth are there. But the other two areas, such as the cash being returned to you and the valuation, I think it really comes down to valuation. I think you have this possibility because the government's juicing the market and you have investors, their attitude might go, "Ooh, I don't want to own it," to, hey, maybe there's something sexy here with an AI play, that it goes from a very low multiple valuation to closer to maybe more of a normal multiple or a higher multiple like what you see with the US markets. And a more normal multiple plus favorable shareholder, policies like buybacks and dividends, I would think might suggest, at least 50 to 100% upside. That's what I'm thinking with the 20 billion slapping on a richer multiple. So it's really valuation expansion driving the thesis. That said, there are still severe overhangs like geopolitical, regulatory, a policy like the CCP could wake up one morning and just crush an investment thesis. And we've seen this multiple times, that have occurred in various different industries in China. They could just say, hey, there's been a disorderly expansion of capital, or perhaps, and this is the one that really makes me uncomfortable, some sort of invasion of Taiwan. And there have been some indications, there have been some stories that really do make me uncomfortable here, such as, Naval News was talking about how China's been building a fleet of special barges suitable for Taiwan landings. And then there's also several stories about undersea internet cables being cut around Taiwan and around the world from various different Chinese ships. So those sorts of stories make this too hard for me personally. I would rather, first of all, that reading those types of headlines just makes me uncomfortable. I don't want this taking up space on my mind on a daily basis. And I would rather find something that A, it feels good for my daily journey, and B, I have that confidence that it checks everything else out on my checklist. Yes, you have the aligned management. Yes, you have the compelling valuation. And it's also, there's this obvious growth for why it should be much, much bigger in the future. I hope this video talking about David Tepper, billionaire, plowing away hundreds of millions more in the Chinese market, buying various different Chinese stocks, has been helpful, as well as sort of a high level perspective on Alibaba, why that's one of his top positions. If this has been helpful for you, please hit that thumbs up, hit that subscribe button. Thanks so much for tuning into Unrivaled Investing.